This Week in Economics on the 4th of February 2018, our first program for the month of February, coming to you from WBRN Radio in Boston and on the Bostonred Network. What happened this week was we were getting the first, I suppose, realistic view of the Trump economic program and where it is going. Last year this time, last year in January, after the inauguration of DJ Trump, there was an assemblage of economists that looked at what the Trump program would bring. And again, there had been some preliminary analysis based upon the campaign rhetoric of the administration as to how the economic pie would be divided up. Obviously, when you go through a legislative process, you don't get everything that you would put forth in your program. But however, the basic tenets of the program have been what the Republican Party and particularly their libertarian version under Paul Ryan and company had been espousing for many, many years. Nothing is new there. Lower corporate tax rate. They finally agreed upon 22%. Now, 22% is a nominal rate that corporations pay prior to the so-called tax cuts. Now you have the tax cuts. You have a mechanism to repatriate monies from offshore, we'll call it. However, though, a number of companies, Apple in particular, have not at this point in time repatriated all of their monies because there is a fee. I forget exactly what it is right now, but I think it's between 11 and 14%. But nonetheless, that is a different situation there, and some corporations actually took a hit in terms of how this tax cut affected their particular lines of business. Now, in general, this is a very interesting situation. You have to look at the types of industries that benefited the most from the tax cut, were what we call the O-line industries, i.e. energy industry, manufacturing industry, to a certain extent, and some of the sectors did not benefit as much was the real estate industry because of the elimination of the home mortgage deduction, basically speaking. Now, at one time, you could make that deduction, make it also on refinancing your home, where many consumers have their most of their net worth is in their homes. But that particular paradigm is changing, and particularly for people that have just come on board. Now, it's a little different there for people that are already on board with these mortgage loans, etc. A two-prong situation for that sector. And also at the same time, and we'll get to it in a minute, from the Atlanta Fed and their projection that GDP could go as high as 4.5%. Now, the problem with 4.5 or 5% GDP is you cannot sustain that in a modern industrial capitalist economy, period. Because of globalization, because of other matters, back to old basic supply and demand. And you usher in inflation. Now, inflation, again, the Fed would address it. They are already talking now about 3 or 4 rate increases. And what happens there, the cost of borrowing is more. And that affects particularly the real estate sector. Now, other sectors that need, say, to borrow in 218 or 219, they're booking that up as fast as they can while rates are where they are. But rates will go up. It's interest rates in themselves. And as that goes up, it costs more. Some industries will be able to take that on. Some industries will not be able to take that on. There was an interesting tweet from Paul Ryan. He is the Speaker of the House, where all tax legislation originates. It was talking about some woman, I believe in Pennsylvania. She got the projected savings about $79, $78. Nonetheless, it amounts to $1.50 per week. And of course, he deleted the tweet. The problem with $1.50 per week savings on your taxes, if inflation goes up, your $1.50 is eaten up very quickly. I was talking to a guy several weeks in the past that in the area where he lived, he had bought a Big Mac and whatever for roughly $7.50 US, and his tax on that was 75 cents. So had he bought a pizza or what have you, and the bill would have been, say, $15 in his area at 10%, his savings there would have been wiped out. In other words, he would have saved $1.50 had he been the secretary, had the secretary been the person. But at the same time, the sales taxes would add it up. In other words, he would not gotten ahead of the game. And also, if the price increased on his pizza or whatever. So these are some of the basic things that you see in this type of economy. And also, you're looking at the market. We'll talk about that. The market fell 650 points because now the bond market is coming back, higher interest rates there, and is seen as a better business vehicle than the equity markets and the stock markets. And this is one thing to understand in a modern capitalist society. The stock market can go up, and that used to be more of an indicator, but basically now it's a 50-50 or maybe actually less than 50-50 in our model. And then you look at, of course, commodities. Now, commodities in themselves, depending on what the commodity is, and we'll get to this when we do the commodities, particularly Brent crude. There was talk of Texas shale replacing Brent crude, which is the Norwegian ban there. It doesn't matter who replaces whom. The situation is now with the oil-producing nations, whether or not they're in OPEC or not, from Venezuela to the Russian Federation, etc., to Iran, Iraq, and wherever. Their prices are better now. This is better pricing than they had in several years. And, of course, this is good for the Russian Federation. It's good for Venezuela. And Venezuela is going to their own cryptocurrency, which will eliminate some of the bottlenecks they have with so-called sanctions. The same problem with the Russian Federation and the Democratic Republic of Korea. A little different situation there because they're an emerging market. But all of these markets, whether they be quote-unquote standard markets or emerging markets, the problem emerging markets have, not the Democratic Republic of Korea, known as North Korea, because they're not in the borrowing. The World Bank will not give them a loan, or the IMF. But for nations that are borrowing money, particularly a few in Asia, but mostly on the African continent, and they will be subject to higher rates paying the money back, which in itself will handicap their economy. So in other words, it's not all glamour involved in this situation. Very, very tricky situation here, because you have a number of things going on you normally would not have in classic models, particularly a Keynesian market model, or even a quote-unquote Arpa-Lapa curve trickle-down type operation. Not much is trickling. $1.50 is not a big trickle. But what you have is that you would not have normally, and the last time, there have been several times we've seen Laffer's curve trickle down. Economics was on a Ronald Reagan. Different situation at that point in time. Much smaller economy. The economy was not globalized, and that is the key right there. Trickle just doesn't trickle anymore. So what they've done to boost this was not only do you get a trickle down from your tax cut program, but at the same time, you are doing a stimulus program, basic Keynesian pump priming. That's with this infrastructure now. It's a little different type of infrastructure. There's a lot of quote-unquote private incentives in there that private industry is encouraged to, investors, that is, hedge funds, etc., to build things as turnpikes, etc. What that means is local municipalities will not get the best deal because they're not getting a government stimulus. They're having hedge fund X, Blackstone, whomever, invest their money in this project. And of course, if the interest rate goes up, they will collect a better portion there. And it depends on obviously what they're investing in. If it's a toll road, the people will pay for it forever. If it's a stadium, the people will pay for that. If it's a plant they're getting, such as the Newark proposition for Amazon, a few $1 billion involved there, forgiveness of taxes, land from the city of Newark, and also from New Jersey. So these are some of the kinds of things that you're seeing out here. That's why it's a mixed bag, and it's kind of baffled some people in with their models. But now we're beginning to see a clear picture, not the whole picture now. Don't just fake because you had some job drops and you had 200,000 jobs created here, but this is the norm for this particular regime. It's not. We'll get to it now, and we'll talk about where it is present time with jobs, and then we'll get to the rest of this. We'll be sourcing from Reuters, the BBC, and the Bureau of Economic Analysis. Let's move on to it. Incidentally, Lawrence Powell is the chair of the Federal Reserve. Dr. Yellen made her final speech, and I'm not sure we'll have it on this one or not. At PBS interview, I should say. There, the policy will be about the same, at least starting off here, but some of this is a bit unknown. Let's go now to the wrong one. We'll now go to the employment situation. This was on Friday. The Bureau of Labor Statistics put it out Friday, the 2nd of February. In January, 200,000 jobs were created. The unemployment rate it's still at 4.1%. Now, the 4.1% is actually the number of people in the last 26 weeks that have been connected with the employment offices, period. And they start this out by saying employment continues to trend up in construction, very unusual for the winter, food services, drinking places, healthcare, and manufacturing. The establishment survey data has been revised as a result of the annual benchmark process and the updating of seasonally adjusted factors as a household. This is the establishment data. The household survey data for January 2018 reflects updated population estimates there. So we'll just tell a little bit where we are. This is a household survey. We always have these two. The unemployment rate was 4.1 in January for the fourth consecutive month. So we are getting a little pattern there. The number of unemployed persons at 6.7 million, changed a little over the month. Among the major groups, the unemployment rate for African Americans increased to 7.7% in January. The rate for Europeans edged down to 3.5%. The jobless rate for adult men at 3.9%. Adult women at 3.6%. Teenagers still much too high, 13.9%. For Asians, 3%. Latinos are 5%. Latinos have a nice unemployment, a little change there. The number of long-term unemployed, those jobless, now this is just 27 weeks. I think we said 26. 27 weeks. It was at 1.4 million in January and accounted for 21.5% of the unemployed. The civilian labor force and total employment as measured by the household survey changed little after accounting for adjustments. The labor force participation rate was 62.7% for the fourth consecutive month. The unemployment population ratio at 60.1 for the third month, so it did not change at all. Getting above the 62.7, 63% is going to be very difficult, because in out years, 219, 220, that number will not increase, it will start to decrease. The number of persons employed part-time for economic reasons was essentially unchanged at 5 million in January. These are individuals with preferred full-time, couldn't get it. January, the 1.7 million people were marginally attached to the labor force. Little change there. The individuals were not in the labor force and were available for work, had looked for a job sometime in the past year, 12 months. They were not counted as unemployed because they had not searched for work in 4 weeks. So they kind of changed this a little bit around. Also, among the marginally attached, there were 141,000 discouraged workers in January. Little change there. The establishment survey. Non-farm payroll employment rose by 200,000 in January. Employment continues to trend up in construction, drinking places, as we talked about before. Construction added 36,000 jobs in January, with most of the increases occurring in specialty trades. 26,000 there. Employment residential building construction continued to trend over the month, 5,000 there over the year. Construction employment has increased by 226,000 people. Food services, drinking places continue to trend up in January, 31,000 there. The industry added 255,000 jobs over the past 12 months. Healthcare, one of the things that was cited with the passage of Obamacare would decrease. It has not. 21,000 with a gain of 13,000 in medical centers in 2017. Healthcare added 24,000 jobs per month. Employment in manufacturing remains upward trend, 15,000. Durable good industry added 18,000. That was the most there. Manufacturing has added not very many jobs, 186,000 in 12 months, a 1 year period. The average work week for private non-farm workers declined by 0.2 an hour to 36.3 in January. In manufacturing, the work week declined also by 0.2 to 40.6, while overtime remained at 3.5. The average work week for production non-supervisory workers edged down 0.1 to 33.6 hours. The average hourly for all workers rose 9 cents to $26.74, following an 11 cent gain in December. Over the year, the average hourly earnings had risen 75 cents, or 2.9%. Hourly private sector production non-supervisory increased 3 cents in January to $22.34. Total non-farm payroll employment for November was revised down from 250,000 to 52,000, to 216,000. That happens around the holidays there. The changes for December was revised up from 48,000 to 160,000. With these revisions, employment gains in November and December combined were 24,000 less than previously reported. Monthly results from additional reports received from business and government and recalculations. The average benchmark was also contributed to November and December revisions. After revision, job gains averaged 92,000 over the 3-month period. About what it was, at least the projection. The next scheduled release will be on Friday, March the 9th. Now, the partial federal government shutdown. Some agencies were shut down. Some were operating at reduced staff levels from the 20th of January through the 22nd of January. The household data was suspended during the shutdown. Household survey data collection results on the 23rd, and it was conducted on the 26th to allow the usual number of collection days. Response rate for household surveys in January was slightly below the average in 2017. The establishment survey collected daily by interviewers. He did this. I remember seeing an interviewer back in the 70s on a personal level. Anyway, the results were on the 23rd. Electronic collection was not interrupted. Now, this is something they do a little bit different there. Collection rates for the establishment survey for this collection period were within the normal range. There was no discernible effects on national unemployment rate and other there. Revisions to the establishment survey data in accordance with for the annual process. The establishment survey data released today has been benchmarked to reflect comprehensive counts of payroll employment for March of 2017. The counts are derived from principally from quarterly census of employment and wages, which counts jobs covered under the unemployment insurance tax system UI. In addition, the data was updated in 2017's North American Industry Classification System from the 2012 system. The results in minor changes to several detailed industries. The normal benchmark revised, not seasonally adjusted data for April of 2016. However, some data was also revised further back in their history than normally due to the implementation of the 2017 North American Industry Classification System. Non-farm employment levels for March of 2017 was revised upward to 146,000 by 136,000 plus 138,000 on a not seasonally adjusted basis. That's 1/10 there. The effects of the revisions on underlying trends in non-farm, and I'm not sure. This is some legacy that's been left over a long time ago. For example, year-over-year changes in non-farm employment was revised to 2,055,000 there from to 2,173,000 seasonally adjusted. The revisions in historic establishment are available at the site there. And anything else we have going on here? Well, I can look at some of the numbers, I guess. Let me get back to them here. Year-over-year levels previously published or revised. If we look back at 17 and look at January, 145,541. It was revised to 145,690. So the difference there, 155. Very small differences in the revised, and we go to November, 218 there. So not very much on revisions, month over month. So look at most of these 2017 on the preliminary scale, adjustments to population estimates from the household survey, that's in 2018, were incorporated in. Each year the Census Bureau updates estimates to reflect new information and assumptions about the growth of the population. In accordance, the Bureau of Labor Statistics will not revise the official household survey data estimate for December, that was 2017, to show the impact of population adjustments. However, differences in selected in 2017 on the old and new population estimates. The adjustment increased the size of civilian non-institutionalized population by 488,000, civilian labor force by 300,000, employment by 318,000, unemployment by 15,000. Number of persons not in labor force was increased 154,000. So that's some of the things going on here. The effects of updated population controls on December, estimate by age, sex, race, etc. here, and just some of the people out here, number of women, men, Europeans, African Americans, etc. Participation rate, the total was 0 for men, 0.1%, women, no adjustment there. The rest, basically no adjustment. There was a 0.1 adjustment for Asians. The unemployment rate, we saw nothing there. Not in the labor force. Yeah, really not very much there. I'm not sure why we're going through some of this, but and this is the household. So we'll just put this on. And we look at some of the unemployment rates here. This is a little bit interesting. Adult men, 20 years and older, 4.4%. I have to get back up at the top to find out where we were here. Okay. That was in January and November of 2017. And if we look at the third bracket, is January here. Let's see, adult men at 4.1%. Didn't overall it didn't change, but for adult men 3.9, now it was 4.4 at one time. For African Americans, it was 7.8, then 7.2, then 6.8. Now it's back up to 7.7. So in other words, very little relief there in that category. Reasons: job losses, persons who temporary job. Anyway, this is some of the things that they have outlined here, and we'll just leave this and head back to. Let's see where we're going to go here with this one. We hit the market here, 650 points. We talked about this. This is an AP story here, but. That was on Friday. They slumped. No doubt about that. Market suffered its worst week in 2 years as the fears of inflation, disappointing quarterly results all hit the Dow Jones at once. Bonds rose and contributed to the demise of stocks. No doubt about that. The government reported wages grew last month at the fastest pace in 8 years. The Dow's the worst decline since June of 2016, while the broader S&P 500 index had its biggest one-day percentage drop since September of 2016. We've enjoyed low interest rates for long. We are having to deal now with a little bit higher rates, and you will get much higher rates. This is from someone at Wells. The sharp decline in stocks this week short-circuited a robust start to the year that was spurred by global economic growth, solid company earnings, lingering emphasis for the enthusiasm for the tax cut. Even with the pullback, major indexes were still up more than 3% this year. The downturn also followed a long period of unprecedented calm in the markets. Well, not there. Anyway, the Dow fell, and we'll get to this in a minute, 59.8 there, and the index lost 3.9%. And the Dow itself lost 665.7 points. That was on Friday. NASDAQ slid 144.9. Of course, interest rates are still low. The pace of rate increase is more important than the level. That's from someone at Life Asset Management, who they are. The bond price declined on Friday, yielding pushing rates higher. The yield on 10-year treasuries, a benchmark there, climbed to 2.84%, the highest in roughly 4 years. The rate was at 2.41% 4 weeks ago and 2.66 on a Monday. So things have started. Once we start growing north of 2.5, and you can put that together in overbought market, it has the ingredients of a sell-off, especially since January. It was so strong that Jeff Zappa, he's with U.S. Bank Private Wealth Management there, and opinions of various people. We try to sort these out if we can. The market slide may have been overdue, particularly after a strong start for stocks this year, where the S&P had its best January in 20 years. The global economy is still strong. Corporate profits and sales have been better than expected this reporting season. Well, yeah, but that sort of changes at times. It's appealing of these 3% pullbacks, who have been trimming some of his stock holdings after the big January thing. This is what normally happens. Exxon was down 5.1%, or Chevron, don't talk about that much these days, 5.6%. After the oil company's latest quarter results fell short of forecasts. Shares in Exxon slid $4.54 to $84.53. Chevron went down $6.99 to $118.58. Apple declined 4.3% after technology company said it sold 77.3 million iPhones in the last quarter. That was below the 80 million expected. Well, the 80 million itself was really not a very good estimate of where they were. They were very lucky to sell as many as they have sold, because the headset market itself has been saturated. Period. Now, the e-commerce giant, that's Amazon, 2.9% in the fourth quarter. Profits increased by more than $1 billion. The shares were up $39.95 to $1,429.95. The price of petrol fell 2 cents to $1.87. Heating oil 4 cents there. Natural gas slipped 1 cent. Gold also fell. I suppose we'll do this in a minute. $10.60 to $1,377.30 an ounce. Silver dropped 45 cents to $16.71. Copper was down 2 cents, $3.19 a pound. Anyway, major indexes in Europe also declined. The DAC was down 1.7%. France's CAC was down 40, lost 1.9%, and the FTSE, actually they were up 0.6%. The Nikkei fell 225. I don't know why I'm doing this early, but this was just a dispatch we're getting out of San Francisco. This is AP dispatch here from there, a business writer on the 3rd yesterday there. So let's move on here. Let's see, where are we? Oops. This is our roundup. Oh, we'll start with the Atlanta Fed. This is the San Francisco Fed. Sorry about that one. Inflation is signs of healthy economy, fast economic growth, strong financial conditions, etc., etc. This is actually from John Williams. He is at the San Francisco Fed. Both possibilities are reasonable. I think at this point, options. After the speech, he downplayed the likelihood of more aggressive tax rate hikes. The expansion is a process is proceeding at a good Unemployment is low. Inflation is finally heading in the right direction. So you don't have deflation he's talking about there. Who votes this year on Fed policy is said to be another only consideration for the vice chair. It's coming up there under Mr. Powell. U.S. stock market fell. 10-year treasuries rose to its highest level in 4 years. Economic data has strengthened over the last month or two, etc. here. Now, this is where the actually Atlanta Fed was in here. The GP Now model spit out an estimate here Thursday of 5.4% growth for the current quarter. This is Q1 we're in now. An unemployment rate lower than most at 4.1. Many officials, including Williams, see inflation picking up this year after several years when it lingered below the 2%. This is the magic 2% the Fed has. He was pleased by the turn of healthy economy. I boasted my growth forecast this year, but I don't see an economy that fundamentally shifts gears. Given the economy's performance almost exactly as expected, you can expect policymakers to do the same. Markets are currently pricing in the same free rate hikes this year that the Fed has forecast. In a separate speech in Austin, Texas, Robert Kaplan from the Dallas Fed said strong economic data makes him more confident the Fed will raise rates 3 times this year. Well, possibly it will raise them 3 times, or it could raise them 4 times. A lot of this will depend on what happens in the Q3 and Q4 of the economy. Wells Fargo, they were ordered to, as they say, halt their growth over compliance issues. New regulation restrictions imposed by the Federal Reserve on Friday that sent its shares sharply down after our trading there. Wells is now grow beyond 1.95 trillion in assets it had held at the end of last year until it sufficiently improves governance and controls. That's what the Fed said. Wells estimated that the cap would cut its annual profits at $300 to $400 million this year, as reducing part of the balance sheet, like corporate deposits, trading assets, in order to continue its core business. That represents 1.5 to 1.9% of Wells' profit generated in 2017. The shares fell 6.1 to $60 after hour. The Fed's consent order will have a manageable impact on profits and should not affect the bank's plans to return capital to stockholders. That's from their chair Sloan. The bank reached a $190 million settlement with the Consumer Financial Protection Bureau, the Office of a Controller of the Currency, and the Los Angeles prosecutor in 2016. Regulators have rarely intervened directly in the bank's operation in the past. It is unprecedented for the Fed. You can explain what's going on here. Explain what's going on to order a stop to growth. Now, this is happening under the Trump administration, and you can tell Wells is outrageous. The bank must submit a plan to the Fed within 60 days detailing how it has enhanced oversight of its board of directors, improved compliance, risk management. Period. We cannot tolerate preventive and persistent misconduct in any bank, Janet Yellen said in a statement on her final day as leader of the Fed. So she leaves, as they say, something for the Fed to think about, period. Since 2016, Wells has taken steps to enhance oversight there. Betsy Duke, a former Fed governor, and it's a recent hired Sally Slungrim, a former Fed officer, as its head of regulatory relations. This is at Wells. Talking about a revolving door. It's very revolving. We already talked about Paul Ryan and his $1.50 retreat tweet, which he as they say, got rid of. And this is more about the Fed, the S&P 500 slump over 3.9%, hitting a record high a week ago. It trimmed its gains to 3.2%. I think we've already talked about that one. S&P surged more than 20% over the last year's sell-off of Friday of 2.12% drop has become rare. No session last year suffered a loss of 2% or more. Well, things are different here, and Chesapeake Energy Company, Harley-Davidson were S&P's worst performers for the week, each down 13%. Harley-Davidson has had problems. Part of that is demographics. Harley appeared to baby boomers, and it was saved by baby boomers 10-15 years ago, buying very expensive $40,000 and $50,000 Harleys. But those people have rode off into the sunset or are riding into the sunset, and younger people are buying other products, period. Number decline for the week reached declining stocks, 27,000, the most since 2014 in July. And fewer than 12,000 U.S. stocks advanced for the week, the lowest since 2014. Again, this is where we get this July 2014. The number of stocks hitting year lows this week reached 3,000, as an amount not seen since 2016. A little bit summary here. Working against the market is February 8th spending deadline, upcoming debt limit issue in Washington. That is still coming around. It has to be solved this week coming up. We're on the 4th. So there are some things here that have to be taken care of. Interest anxiety. This is all from Reuters here. Stocks took their biggest pounding since September 2016. That convinced investors that the threat of inflation, long-tamed since the Depression, is growing larger and sent bonds soaring. And no doubt, we talked about the benchmark 10-year Treasury is on pace to top 3.5% this year for the first time since 2011. That was right after the Depression. Risk-free bonds are becoming an increasingly attractive place for yield-focused investors, no doubt about it. At the current forward price-earning ratio of 18.2, that's according to Thomson Reuters proprietary research there on the index. 5.2 yields well below historic norm of 6.7. We don't see a line in the sand, but the 10-year Treasury near 3% is starting to look a lot more attractive. That is from Mike Dowdall. He's a portfolio manager at BNMO Global Assets Management. So when bonds are up, stocks are down. The sell-off in bonds had gathered a pace this year, and yields on 10-year Treasury are hitting a 4-year peak. The yield on the 10-year Treasury right now is 2.84% from 2.46%. At the start of the year, this is the swiftest rise since November of 2016. There's already signs investors are moving quickly into actively managing stock funds in order to sidestep the impact of rising rates. U.S.-based active stock mutual funds, which lost $7.2 billion in outflows as investors move towards passive stock exchange traded funds, ETFs. attracted $2.4 billion in new assets during the week that ended on Wednesday. This is from Lisper, data from Lisper. So in other words, we're starting to see new patterns of trading. We'll be watching out for this. Consumer discretionary stock, which tend to outperform during the periods of inflation due to rising. We're up 8% over the same time. Stock-sensitive rates are leading the market lower this year. Real estate stocks in the S&P 500 were down 3.7% last month. Utilities also down 4.6%. Fund managers say they expect that the other growth-oriented sectors such as technology and financials will continue to outperform thanks in part to pick up inflation and the Republican-led slash in corporate tax is now overall 78.1% of companies in the S&P 500 have reported quarterly earnings above expectation compared with 72% last year. Well, yes and no. This is a very kind of interesting. It's not yes and no, but they have not reported. But it is a different time. So watch out. Very, very careful here because although they reported increases in terms of probability, the reporting period itself could have been an outlier because basically if you look at psychology of the market, they were preoccupied the last 6 months of the market for sure with the tax overall. Well, now you've had the tax overhaul, so and you're starting to see some of the consequences of it. But plus at the same time you're seeing inflation rise, and inflation rises, people move out of the market. And also you have the Apples of the world, which have been overrated for a very long time. Even Google is having some problems now, and you have to look at Apple is not only an American market but a global market, and the headset market now is flooded. Samsung is out there and various other people out there. There are all types of headsets, and what is starting to complicate things is that the quality of headsets being made by all of the major OEMs, manufacturers, whether it be Samsung, Apple, the people that make it for Google, are much, much better. More features, etc. And as each features come, you'll start to get parity. You'll effectively have the same smartphone from Samsung, but you have from Apple, and who will be able to do the most features. And that will start to level the market off and then become more consumerized, because I was talking to my doctor. I think he was on an Apple 6. No reason for him to go to the Apple X or the Apple 10, because he doesn't necessarily require the few features that they have now. So a lot of that will go in as the technologies advance. They will advance in such a way. We're looking at things like screens made out of sapphire will be much more durable. Other kinds of qualities of cameras, battery life, and that thing. We'll get to basically for us old timers around with processors at the Moore's Law out there, doubling of speeds, etc. Got to the point that you had parity with all the manufacturers, and people quit talking about how fast their processors were. This is on the desktop. But the same thing is happening now with smartphones. The processors are getting much, much faster. There's also talk of going to G5. We have 4G now, 5G, faster networks. The government's possibility of the government leading the way. In other words, they would build a G5 network, which would be good for the American economy. And we see that as a basic boost because you have to have fast internet service to do other kinds of things. And as you get, particularly here, we've looked at a lot of economicx.coms or whatever they are, or these other services that offer all kinds of financial services that offer specialty, a niche, or whatever you want to call it, analysis. They are growing and growing and growing. So the whole idea is to get data, and the faster networks you have, the better you can get the data. And as you go into emerging nations, take for instance an emerging nation like Thailand, they have gigabyte service out to many of the villages that don't have here in rural areas. So when you get those types of services, people, they can then access knowledge. They can watch the online classes from the Massachusetts Institute of, say, Technology or whomever, and take some of the same coursework that students at these leading universities take, particularly in information technology. Various universities that are offering, say, master's degrees, etc., they can look at those and find the information and find it on. I'm taking an IT course now that you can find a lot of the information. I don't get too much into Python and some of the other languages, but you can find that information all over, quote-unquote, the net. And as long as you have a connection to the net, it doesn't matter where you live, but you have to have a connection. So if you're in an emerging nation, say Togo or wherever, you get electricity to the village, and then you get internet service to the village. It expands the village. And then you can set up an ecosystem of development. Particularly, you can develop your own applications, design those for Android or whatever you're designing there. There's a little trial project in, I believe, West Virginia, where some coal miners were, this was just a 3-week course, but they were taught to code, and the ones that successfully completed the course would make $40,000 a year. That would be their starting off point. But this will, you'll see happen in many parts of the world, that you will have various courses of this nature where people will start to quote-unquote code. Now, that doesn't mean all will be at the same levels, but they will be able to do the types of work, or very similar work is done in the developed countries. And out of those programmers, say if you had 100 programmers, you're going to have 2 or 3 of them will eventually get to be world-class or beyond. They will teach others. So this is how you start development, and it's a very inexpensive development because you can use very cheap hardware. And since you now have the cloud, they can use that also. And I didn't intend to get off this, but I'm giving a topic through next Saturday on development, diversity and development. They have to both be there. If you are looking at certain sectors, say information technology, the Googles, the Facebooks, yes, you have to employ people from all backgrounds, cultures, nations, and particularly in the U.S., African Americans, Latinos, and women. But you also have to develop these people because you have development, as the Chicago minister Jesse Jackson would say, in slavery everyone had a job, but no development. And so this is why we talk about it as a development situation. Let's go to the BBC now. We need to get there. The headline here is Dow sees sharpest drop since 2016. That in itself is not the significance of it. The significance of it will be how long they will be dropping. We'll see this week coming up. And also at the same time, how the effect of the budget. That is on the 8th, 4 days away here. And he's look at my little calendar here. So that come up on Thursday. Got to be fixed. They're talking about another short-term fix to March. It's like Barnum and Bailey's Circus is coming to town, and they changed the date. Anyway, another headline here for the BBC is the jobs and wages rise. Yeah, well, it was minimal. 6.9%. The average hourly private sector creeped up to 6.9%, compared to 2016, about 3% there. In other words, that's 3 cents on a dollar. The unemployment is the same, so you're not going to see anything out of that period. The Labor Department showed the average hourly earning private sector worker rose 9 cents in January. That's the average now. That's $26.74 for the year. That's an increase of 75 cents there for the average, 75-cent increase. And upticks here. Walmart also said they plan to boost earnings and provide bonuses. That was a $200 to $1,000 bonuses. They went up $1 because of market conditions. But the unemployment rate, again, reemphasized here at the BBC for African workers, jumped to 7.7% after falling to 6.8% in December. So in other words, that's fractionally up and down. And we see a tight, we'll look at the next time around. So basically the 3 months, we're back to 192,000 there compared to 200,000 last year. So it's not as good. This will be an interesting trend here, period. And they also mentioned labor force participation rate. During the campaign, DJ Trump talked about boosting that up. 63% is basically about as high as you're going to go with people coming out of the market, because the problem is, even when you boost your the number of people employed, you're also losing people that had been employed too, so it's up and down. Now, Google, is known as Alphabet, they've also started to lose a little steam with quarterly profits. They have $6.8 billion. That is 484 billion pounds, missing of the 7 billion. Well, revenue jumped by 24% to 32.3 billion, helped by sales on their search engine and web applications. Overall expansion climbed, and Alphabet spent money on diversifying beyond its core business, invested in YouTube. YouTube is becoming more and more of that business. The shares fell more than 5% after hours. There, the results October to December period, excluding a one-time $9.9 billion charge related to the tax code, would that will lower corporate rates. Revenue, of course, jumped. That's in its core advertising business. Now, that in itself is based upon what consumers do. Its algorithms have become more effective at delivering mobile ads, helping generate revenue topping $100 billion for the first time. So those rates are coming up. They've always lagged behind on most people on mobile, but that in itself is changing. More search are now being done on phones. Google has been paying more to encourage its to ensure its search engine is a default option on products, including the iPhone and the Firefox browser. We use DuckDuck, and we also use Google. But I will say that Google is not as good as some of the older search engines were for those of us that you can modify it. Anyway, the core ad business is booming. The firm is also investing in other new ventures, including expanding its cloud computing services, developing self-driving cars, and health sector technologies. That's the same thing that the Oracle of Omaha and Amazon and the bank, there are JP Morgan are going into also. So we're seeing some new things. They announced board member and former Stanford University president John Hennessy would replace, something new, I didn't know that, would replace Eric Schmidt as the chairman of Alphabet. Didn't know that. Pick up something new. This is one reason we use these various services here. Nonetheless, the BBC will do the numbers here. The BBC Global 30 was down 133.29. This is on Friday. This is on Friday unless otherwise reported. And today, with all the negative numbers, it'll be in the negative, and we'll say in the positive. Nonetheless, the FTSE All Share was down 29.27. In Amsterdam, they were down 6.79. The DAC was down to 18.74. In Paris, they were down 89.57. In Brussels, 50.04, not 4. In Madrid, they were down 187.80. In Zurich, 70.23. In Moscow, they were also down 20.73. Everybody was down. In Johannesburg, the all shares there was down to 94.82. In Bombay on Friday, they were also down 839.41. In Karachi, in the positive, 45.72, one of a few bright spots. In Lahore, they were down 45.11. In Colombo on Friday, 22.001, they were in the positive. And in Tehran on Wednesday, negative 224.40. In Sydney, 31. The Nikkei was down to 11.58. The Hang Seng on Friday was also down 40.31. And in Shanghai on Friday, 15.10. In New York, they were down again, that magic 65.75, or 2.47%. The NASDAQ was also down 144.92. The commodities market out in the Midwest city of Chicago was down 59.85. And in San Pablo on Monday, they were down 1,046.17. I wondered about that one. In Mexico on Friday, they were also down 648.42. They've been down the whole year. I don't even know why we deal with it. Anyway, the Brent crude futures on Friday were down $1.38 at $68.27. On Wednesday, the spot was up 76 cents at $58.59. And West Texas crude was down 75 cents, but it was still at $65.05. We were talking about it replacing a Brent crude, which is the Norwegian part of it there. Gold was up also, $3.90 on the Forex, gold futures that is, at $1,345. Dubai gold was down $14.70 at $1,334.50. Silver was down 6 cents at $17.14. We'll go to Unex Life futures, and cocoa was down 24 cents. Robusta coffee was down $41. That's a good sign there. Sugar was up, white sugar they call it, $4.90. Cocoa was up 75 cents. And the Bloomberg Commodity Index, which was out on Wednesday at 1550, at 85.59. So that does it for the numbers. I think we've straightened up a few things here. And the outlook, well, we'll see next week what the market does. That's one of our indications there as to where the market is going next week. And we'll see if the sell-off continues. Part of the problem here, and again, we'll have the week coming up here, the budget. Will they have another short-term fix? At some point in time, this will become very contentious, and it will start to affect the market psychology. And this is what has been keeping the market up, and you had the record numbers, was just sheer market psychology from our standpoint, and not necessarily the bare-bone factors. Some of the corporate earnings here were up because they anticipated the tax cut, and also at the same time A lot of what goes, particularly in the stock market, is a psychological situation. So if you recall, during the administration of Barack Obama, there was always very, very negative news about the economy that kept it somewhat suppressed. But again, it generated roughly for every year that President Obama was in office. So it continued on and on and on. But now you have new aspects to it, a more laissez-faire, whatever aspects. And traditionally, on the small economies, on Reagan, the markets have done well the first few months of these types of administrations. But they level off. The same thing happened with Reagan. Reagan had some dramatic drops, but now we have better controls there. As what happened with Wells Fargo. If we would have not had the Dodd-Frank controls, Wells could have upturned it, and Wells and some of the other banks would have taken the country back into a very severe recession and perhaps a depression. And this is the problem that you have with these people taking regulations off. But with all the quote-unquote stimulus you have out there, such as the freewheeling policy of drilling in various government wildlife reserves, taking off all the regulation, most of the regulations. In other words, you open up the spigot. But the problem with that is, even opening up the spigot, we'll get into a full year of this open spigot operation. If it doesn't generate substantially in terms of GDP, and even if it does, inflation will go up. Thus, you start to see the interest rates go up. We'll put the bricks on other parts of the economy. Very, very uneven. And if the brick is on the consumers, now a lot of the consumer discretionary spending for the holidays was either from savings or borrowed money. That's one very point to remember. And that is not sustainable. So you have a lot of things here are not sustainable. Modern economies just do not interact with it. We didn't have the news from China this week. Out of the UK, they still got Brexit there. They've got to get through that, I believe, by March. And it will have negative effects on the British economy, which is not as strong as people think the British economy is, or some have thought. It was not the kind of economy that should have gotten out of Brexit to begin with. And depending on how that is sorted out, it will have an effect there. And some corporations are moving out, some are moving in, but a lot of that is more PR. It's sort of like the round table at the World Economic Forum. And a note on that, we will still be presenting some programs from the World Economic Forum that are very, very timely and really didn't get very much publicity, we'll say, PR. Even on their YouTube channels, people send over look at those, such as looking at stimulus, universal incomes, those kinds of things. For those in business, make next week a proper one. For the consumer, obviously keep your eye on the prize. The winter is here, so I'm assuming they're still selling some winter clothing. The spring clothing is not out there yet. And where the bargains are, as they say, we'll look at this headphone situation. And Apple has kind of hit a brick. And we'll see if there's some relaxation in headphone pricing and also pricing of general services such as the Comcast, etc. Good day.